Today on the Blockchain Report, Bitcoin stuck at 113K, probably because Coinbase's CEO is calling for $1 million, while analysts are screaming, bro, can we just hit 124K again first? Michael Saylor says ignore the bears after his stock nuked 21%, and Robinhood just added sports betting because losing money on meme stocks wasn't enough. Now you can blow it all on the Cowboys too. All that and more on today's show. Let's go. Good morning, my Bitcoin besties, and welcome back to another episode of the Blockchain Report. I'm Hank Hudson, reporting live from San Francisco, the city where parking tickets are somehow even harder to avoid than altcoin scams. Careful chasing that alpha out there, kids. Now, before we wade into today's ocean of diamond hands and paper cuts, let's play a quick game of financial charades. Act like you sold the top when in reality you panic bought the middle, and while you're at it, hit that like button like the way your IRS hits your bank account, aggressively and without any remorse. Now, don't forget to follow RoxomTV and me at Hank at RoxomTV on all platforms that matter, because in crypto, every pump has a punchline. All right, let's find out who's winning, who's whining, and who's refreshing coin market cap like it's Tinder as we break down the numbers in this morning's market rundown. Let's get to it. All right, it's Thursday and the numbers are looking more of the same. Right now, Bitcoin chilling at about 113K, Ethereum hanging out around 4,200, 4,300-ish. We got XRP down 2%, almost to 290, 289 currently. Cardano also a bit of a dip, down to 86 cents. And Dogecoin joining in on the not fun, down almost 2.5 percentage points this morning, hanging out around 21 cents a coin. All right, we got a lot going on today's show, including not one, but two special guests. So a lot to get going here today. So let's run the stinger and start with this morning's bull run right after this. All right, welcome back. Now it's time for this morning's bull run. I got a little ahead of myself there because I'm very excited today, because right off the jump, we are going to be joined by our first special guest of the day who will be doing our bull run with us. So he is one of those rare voices in the Bitcoin space who's managed to bridge every corner of the space itself. We're talking from writing that shape the conversation to guiding institutions to building products that push adoption forward. He's part analyst, part builder, part educator, and all in on changing the way people think about money and home ownership. Let's give a big Blockchain Report welcome to Joe Consorti, everybody. Oh, Joe, our audience is thrilled to have you here, and so am I. How are you this morning? Thanks for joining us.
Having me. Sorry I couldn't be there in person, but pleasure to be chatting with you.
That's okay. In time, I'll learn to forgive you, Joe. We'll get you in here one of these days. Now, before we get into the meat and potatoes of today's news, Joes, I would love to kind of get a little bit about your background for our audience that's not familiar with you yet. How did you go from studying economics to becoming one of the go-to voices on Bitcoin, Wall Street, and now building products in this space? Tell us a little bit about it.
For sure. Yeah, so I just did stuff, mostly flying by the seat of my pants, right? Yeah, I mean, ultimately, I had a great interest in Bitcoin and global macro. I originally went to school to be a doctor, and then at some point along the way, I realized that I didn't want to go to school for 12 years, and I would rather talk for a living. And so I kind of went from there, excuse me. The school that I was going to gave us free access to Bloomberg terminals in the business school library. So I basically spent most of my days doing three things. That was going to class, and then going to the gym, and then going to the library to teach myself the Bloomberg terminal, because I knew it would be a valuable skill kind of anywhere that I went. And so, COVID hit in my freshman year. They sent us home during spring break. That left me pretty jaded toward kind of these higher echelons of power, if you will. And so that was kind of a natural segue into Bitcoin. I went to school with a couple of buddies who now are pretty big names in the space. They also work in Bitcoin. and they introduced me to it and dove down the rabbit hole, as it were. And so as I was studying traditional macro and the way that markets worked, and getting a sense of how to build out a mental framework for that, I was also learning how Bitcoin fit into everything. And so I just started publishing my research and my writings, and I kind of used it as like a living resume, if you will. I used my writing as a living resume. And somewhere along the way, 2022, my junior year, I got picked up by Nick Bhatia over at USC to start building the Bitcoin layer, which is now one of the biggest Bitcoin and global macro research firms. And if not the foremost Bitcoin and global macro research firm. And then from there, I just continued to build and build and build. I joined Thea to build out their collaborative custody platform. And now we're building Horizon, which is a unique Bitcoin and home equity platform that lets homeowners stack Bitcoin using their home equity. So it's been a pretty fast 5 years since I first got into Bitcoin, basically just nonstop building stuff, but I wouldn't have it any other way.
Amazing. I mean, that's a pretty impressive resume in a relatively short amount of time. So we are super excited to have you and your expertise, experience, and insights chat with us about some of today's top news. You ready to rock and roll?
Absolutely. Let's do it.
Let's do it. All right, so hang tight. We'll be back with you in just a second, Joe. But first, Coinbase CEO Brian Armstrong, well, he is the latest Bitcoin bull to break out the good old vision board. On the Cheeky Pint podcast, Armstrong said he sees Bitcoin reaching $1 million by 2030. Let's take a look at the clip.
What is your prediction for the 10-year rate of growth, like average annual growth in the Bitcoin price?
The rough idea I have in my head is like we'll see $1 million Bitcoin by 2030, and there's high error bars around these things. But just to give you a couple of data points, right? It's like we're starting to see regulatory clarity emerge in the United States, which I think is a bellwether for the rest of the G20. You have the Genius Act passed now for stablecoins, but this market structure bill is being debated in the Senate. Fingers crossed, something could happen by the end of this year. That would be a huge milestone. The United States government now has a strategic Bitcoin reserve. So that is, if you'd asked me 5 years ago, that would have been kind of like vision board. Someone would have said, you're crazy. Like the United States government's not going to officially hold Bitcoin. But if they do that, which there's now an executive order to do, I think a bunch of other countries are going to do that.
Well, you heard it from the man himself, $1 million per coin by 2030. Because apparently if you run a crypto exchange long enough, you start making predictions like a fortune teller at Coachella. Now, Armstrong is not alone. Eric Trump, the blonde one, says it's no question Bitcoin will hit $1 million. Eric even calls himself a Bitcoin maxi now, which is hilarious because if you told me 10 years ago that one of the Trump kids would be a Bitcoin diehard, I'd have guessed it'd be Barron. But not everyone is strapping on rocket boots just yet. A researcher from the University of Pennsylvania says, let's try to hold 124K first, guys, which is fair considering Bitcoin spiked to 124K and then face planted back down to 112. Meanwhile, Galaxy Digital's Mike Novogratz warned that cheering for $1 million Bitcoin next year isn't bullish, it's apocalyptic. His point, if Bitcoin hits $1 million in 2026, the US economy is basically Mad Max and you'll be using your Lambo as a tent. So exciting times ahead. All right, we're bringing Joe back to the show. Joe, when you hear Brian Armstrong calling for $1 million per Bitcoin by 2030, do you see that as genuine conviction or just Coinbase's version of a motivational poster?
Coinbase's version of a motivational poster. I mean, ultimately, Coinbase's game is to drive users to their platform. The way that any non-Bitcoin only crypto company, as it were, works is particularly Coinbase and the likes of FTX and Binance and others is listing as many tokens as they possibly can to farm fees. That's their business model. So ultimately, it makes a great deal of sense for him to be calling for things like $1 million Bitcoin. It drives people to his platform so they can farm fees. A more measured take would be this. And I totally agree with Mike Novogratz. I've said this so many times in the past that you don't want Bitcoin to be $1 million within the next 12 months or within the next 5 years even, because that means something terrible would have had to happen in the world economy. And probably the price of Bitcoin is the last thing you'd be worried about. Bitcoin ultimately, it acts as this apex asset, this apex hedge against perpetual monetary debasement. We live in this credit-based global economic order where money is lent into existence. And so Bitcoin acts as the best hedge against that. It acts as the best sponge for global money supply and global liquidity. It tracks credit cycles very closely. And so ultimately, if Bitcoin were to be $1 million within a year, 2 years, 5 years, something horrible would have had to happen with the global financial system. So I'll say that. But the more measured take, and the take that I think people should be optimistic about, is that if you look at prior cycles, the way that Bitcoin used to behave compared to the way it behaves now, boom and bust cycles are getting far less volatile, right? They're not a thing of the past, right? But they certainly are less volatile than they once were. One data point that should be really encouraging to viewers is that last cycle, Bitcoin spent only 39 days above $60,000. That was basically the key psychological level. It hit that, 64K and 69K all-time high twice that year. So far, since Bitcoin first broke above 100K, it spent 131 days above that level. And it's now spent 45, 46 days above 110K. You can see the price behind me. And so ultimately, this consolidation we're experiencing is extremely healthy relative to prior cycles. And so, other folks, Matt Siegel, who I'm friends with, has spoken about 180K by year end. I think that's a totally reasonable target. Right now, the reason Bitcoin, is kind of channeling where it is not just because of its own native factors, but also because right now the Jackson Hole Symposium is happening in Wyoming. And usually every single year when this happens, equities kind of trade around doing not much of anything. The U.S. economy is pretty robust and resilient. We're going to be expecting the Fed's first maintenance rate cut of 25 basis points next month. So really the path of least resistance for other risk assets is higher in the near term. And people can probably expect this kind of stair-step price action of consolidation, then moving up to a brand new all-time high, and then consolidation through the end of the year until the macro regime changes.
Yeah, we're at this really interesting inflection point, I feel like, in Bitcoin's journey from being initially considered as a risk-on asset and now starting to kind of fulfill that promise as a true store of value as digital gold, right? But with that, you have these big price predictions, which were great and fun, right? But the fact that people are saying $1 million, I don't think that's indicative of where we are with Bitcoin right now. Slow and steady truly wins the race. And if we want to treat Bitcoin and want the world to treat Bitcoin as a reserve currency or as a store of value, slow and steady is the way to go. And I think you're very on point with, we're not seeing those crazy shifts that we had in previous cycles. It seems to be a lot more just watch a number go up, but slowly and steadily. And I think that's a real credit to the maturation we're seeing of Bitcoin as an asset class right now. So fun times, maybe not as fun if we're looking for those parabolic rallies, but I think we can safely say, you and I can, Bitcoin is definitely here to stay despite some of those detractors out there. At an institutional level, do you feel like these $1 million price predictions are helpful in pulling new allocators to the Bitcoin space? Or do serious investors just kind of roll their eyes at this kind of stuff until Bitcoin proves itself step by step, kind of what we just talked about here?
Yeah, for sure. So I think there are two different cohorts when we talk about institutional allocators. The first being obviously the folks who are buying these spot Bitcoin ETFs in size, those being pension funds, endowments, and others. And those are, types of allocators who plan on buying and holding it for a very long time rather than selling it. Pensions in particular, right? They're not the buy something and then sell it immediately type allocator. They buy something, hold it for a very long time, and then gradually wear down that position. And, with endowments, they just hold on to these things for decades at a time. You look at places like Harvard and Brown, they're perfect examples. Harvard bought $117 million worth of IBIT. That's BlackRock's spot Bitcoin ETF in Q2. And so ultimately, that is cohort number one. We're talking about institutional allocators. And I think the main thing that drives them to this asset is two things. Number one, it's price performance relative to other assets. Actually, on our website on joinhorizon.com, we've shown basically over any 3-year period over the last 12 years, Bitcoin is the best performing major macro asset. You compare it to the S&P 500, to real estate investment trusts, to U.S. Treasury bonds. That's anything 10 years and up on the U.S. Treasury yield curve. Trounced all of those things. And so, that's factor number one. And then factor number two is ultimately an asset that hedges against the current macro regime, which I spoke about briefly. But basically, we're entering into a period of fiscal dominance. We haven't seen one since World War II. And essentially what that means is that keeping rates at a low level keep the debt manageable is more important than any other thing that monetary policy sets out to accomplish. So monetary policy obviously has a dual mandate with the Fed. Stable prices and full employment, right? And by stable prices, it's a bit of a misnomer. What they actually mean is making sure that CPI goes up by 2% every single year. On an annual basis. So that's its dual mandate. But now, given the fact that our debt load is so high, $37.2 trillion with a debt ceiling that was just raised to $41 trillion by 2031, and the more pressing concern is the interest on that debt. The interest on that debt is now approaching $1 trillion. It's on track to surpass $1 trillion and approach $1.1 trillion annually by the end of this year. And so the primary concern now is keeping rates low. And so that's why, even though the U.S. economy is rebounding, we are going to be cutting, and the market is betting on 100 basis points or 1% worth of cuts over the next year between now and next July. So that's essentially the era we're in. The Fed is now not just acting on that stable prices and full employment mandate, which it is clearly achieved. I mean, CPI has basically hovered around 2.7% for several months on end. It's now more concerned at the behest of the U.S. Treasury to make sure the interest expense on our national debt is manageable. And so that's a great environment for risk assets. It was a phenomenal environment for gold post-World War II. And it's a phenomenal environment today for Bitcoin, which is an asset that performs gold's chief function better than gold itself. So that's essentially the era we're living in. Despite a pretty robust economy, despite price inflation coming down to manageable levels, the Fed is cutting anyway. And basically the only reason they're doing that is because of the interest expense. This is only going to accelerate as our funding needs continue to remain exactly where they are as a country. Cutting spending hasn't worked out very well for us. And Jerome Powell is set to be out in May of next year. And Trump is undoubtedly going to pick someone who is working for the Treasury, working for what Trump's aims are to do, and that is to be making sure the U.S. government stays solvent, the Fed doesn't have to print money to buy the excess debt. And so chances are he's going to pick someone, he's going to nominate someone who is even more dovish than Powell. He's going to make sure that whoever gets in there keeps rates as low as they can so that our debt levels are manageable.
Mm-hmm. And I know there's been some talk, we've had this tariffs, and we have record tariff money coming in now thanks to Donald Trump just throwing tariffs at everybody he can find. And there's been talk of people saying, well, why don't we use some of that tariff money, because it's technically budget neutral, you won't have to charge the taxpayers, to buy Bitcoin to potentially help solve some of that debt problem. I mean, number go up, right? Do you think that's a feasible solution? Or do you think that's just people talking because right now we're finally getting some government regulations in the space?
Yeah, I mean, it's partly a solution. There are a couple of things that come to my mind. I mean, year to date, we've had about, I think, $117 billion, if I'm not mistaken. The Financial Times just put the figure out. Scott Bessent, U.S. Treasury Secretary, just said it a few days ago or yesterday. And currently we're running a $2.2 trillion annual deficit, so more money that we're spending than we're actually taking in. So if we allocate 100% of the tariff revenue to paying off the deficit, then it tackles about 5% of it. And the year-end projection, because not all of these tariffs have gone into effect, is about $300 billion. But again, that figure, our annual deficit, is $2.2 trillion. So if we allocated 100% of it, you'd be looking at 15% of the deficit being managed and being taken out by this tariff revenue. The thing is, the asterisk here is that not all of the tariff revenue is going to be going to paying down the deficit, which is a really silly thing. If that was our sole aim, then it's what we would be squarely focused on. And despite what economists may be suggesting, that's not what the U.S. Treasury is squarely focused on, which is kind of insane in my mind. But it makes sense from another point of view. If you consider GDP, the sole barometer by which the Federal Reserve and the U.S. government gauges our nation's economic well-being and our economic productivity, government spending is a massive component of GDP. It's about 40%, 35 to 40% of that GDP metric. And GDP, by the Fed's accounting, needs to be rising by 2% to 3% quarter over quarter. That's what they want. And so if suddenly the government stopped spending more money than it had, and it stopped spending this, fresh money into the economy, that would be a very bad thing. And so, all of these cost-cutting measures and all of this talk about reducing the deficit are running directly up against one of the primary ways in which GDP stays at that level, which is a core function of the Federal Reserve, making sure that we don't have 2 consecutive quarters of negative GDP growth, because that constitutes a recession. And so if the Fed's main game is to make sure that we don't have any kind of prolonged recession, but on the other side of it, the U.S. Treasury is talking about cutting spending and reducing the deficit, these two things are not lining up with each other whatsoever. And so ultimately, like, there are 2 different situations in which we get out of this scenario. Number one is that we cut spending and induce a multi-year, potentially multi-decade recession, right? Totally eliminate the deficit, and in doing so, all of its contributions to GDP, right? A recession can happen. A multi-year recession can happen. The Fed has made sure of it. It let the music stop in 2008. It's never going to let that happen again. So that option's off the table. Option 2 is keep rates as low as possible so that we can erode the value of the principal and interest we're paying back to U.S. Treasury holders. And we have chosen option 2. Given the fact that the U.S. economy is rebounding, and even Fed members are saying that inflation risk and reacceleration risk are larger than recession risk, yet we're still doing a maintenance cut next month. That tells me it's essentially full steam ahead on eroding the real value of the debt that we're paying back to bondholders. Translation would be long risk assets over long Bitcoin over the next 5 years, 10 years, several decades, because they've chosen option 2, and that's clearly what they're going to stick with.
All right, well, it sounds like we're in a good situation for number to continue to go up. So I don't know if we're going to see 1 million by 2030, but I think we're on a good track right now. So eventually, I think we'll get there. We'll see. And I know one guy who's definitely think it's going to 1 million and a lot more. We're going to talk about him right now. So just hang tight, Joe. We're going to bring you back here in a second. And we're talking, of course, about our Lord and Saylor, Michael Saylor, and his company Strategy. Their stock, there he is. What's up, Mike? So Strategy, well, their stock right now, it's wobbling, and that's putting it nicely. And investors are kind of starting to sweat bullets because of it, because Michael Saylor, well, he's doubling down on cosplay memes and orange coin sermons. On X recently, Saylor posted this rallying cry saying, "Ignore the bears." There it is. Oh boy. He paired it with another AI-generated image of himself dressed like a hunter, strolling through the woods with a bear trailing behind him. And I was talking about this with my our producer Victor earlier. I'm so pretty sure you're supposed to face the bear. If he thinks you're running, he's going to chase you. But Michael Saylor, he is not one to be intimidated by anything, apparently. Because when your company stock is down 21% in a month, I guess you just choose to fight back with mid-journey art. Cool. Now on Tuesday, Strategy shares fell 7% down to $336. That's the lowest since April. Now the trigger to this, well, Strategy broke one of its own promises. The company had once vowed never to issue new shares below 2.5 times its net asset value. This week, they scrapped that policy. Now, Strategy says it can issue shares below that threshold to pay debt interest, fund preferred dividends, or basically whenever it feels like it. So investors were not amused by this. One X user summed it up saying, "Promising investors one thing, then changing very soon after is not a good sign." Saylor's meme about ignoring bears looked like a whole lot like a response to that very criticism. But the dip, it didn't stop him. On Monday, Strategy revealed it had bought another 430 Bitcoin worth just over $51 million. That brings the company's total stash to, let's hit the drum roll, please. Here we go. 629,376 Bitcoin, valued at more than $71 billion at today's prices. So here's the playbook here. Stock falling, promises breaking, investors complaining, and Saylor, well, still buying Bitcoin, still posting memes, still telling you to ignore those bears. The man doesn't just hold through the pain, he buys more and calls it a strategy. All right, we're bringing Joe back. Joe, Michael Saylor posts a meme saying ignore the bears while Strategy stock is down 21%. Do you see that as brilliant conviction marketing or just noise covering investor pain?
Yeah, well, I mean, ultimately, one thing I'll say about Michael Saylor is that he's a visionary guy, right? He was the first man to show that it would be a profitable move for a company to simply acquire Bitcoin and not do much else, right? He leverages access to capital markets to sell equity and sell debt, and then use those proceeds to buy Bitcoin. And now it's going off and doing even more exotic things, like creating these new types of fixed income instruments through its preferred stock suite and offering those to investors. And so obviously, you know, he's tapping markets that clearly have been yield starved over the last several years and decades, particularly, in this post '08 regime. And so, there is a little bit of volatility to be expected. I do think that issuing the MNAV guidance at the time, I said it was a good idea. In hindsight, given all of their obligations, whether it's dividends or interest payments on its debt, it seems to have been a mistake. Clearly the market is reacting as such. A lot of the folks who were, part of that sort of MSTR fan group, you could say, are turning against Saylor. They're pretty upset about him. But ultimately, the way to think about strategy and what they're doing is twofold. Number one, their equity, and by extension, all of their preferred stock, is a levered Bitcoin play. And so during these periods of extreme consolidation like we're experiencing now, whenever you apply leverage to an asset that's moving sideways, the leveraged asset, MicroStrategy in this case, goes down. And so ultimately, the only time a leveraged asset does extremely well is when the underlying asset is doing well. And so for as long as Bitcoin keeps consolidating, MicroStrategy will continue experiencing this kind of stock performance, ceteris paribus. The second thing is that on a long time horizon, right, I'm talking 5-10 years, MicroStrategy and other Bitcoin treasury companies, the ones who are successfully creating new types of financial vehicles that are Bitcoin adjacent and satisfy the mandates of equity and credit markets that don't have access to spot Bitcoin or the spot Bitcoin ETFs, they're morphing more into a Bitcoin bank, creating these types of financial instruments to satisfy corners of the market that currently can't purchase and hold spot Bitcoin. And so ultimately, that's the trend that I'm seeing here when it comes to institutional Bitcoin adoption over the next 5, 10, 20 years. The Bitcoin treasury company trend, I don't believe really is a trend. I think ultimately there's several fair weather friends, if you will, who are just, they have a ticker, they're buying Bitcoin, they see that it's popular, and they want it to do good things for their stock. Those are the folks that will ultimately be a zero over the next couple of years. The folks that I think will have staying power in this market are the ones who are successfully creating these new types of financial vehicles for other corners of the market to invest in that currently aren't satisfied by spot Bitcoin and spot Bitcoin ETFs. About $30 to $60 trillion worth of institutional capital in the United States cannot hold, based on its mandates, either of those two things. It has no access to spot Bitcoin. And so ultimately, weathering these storms, accumulating Bitcoin through intelligent leverage, and then creating financial vehicles for that trapped institutional capital to have some kind of Bitcoin exposure is a noble pursuit in my mind. There will be hiccups along the way. I think these companies and the ones that do it successfully are going to be some of the most valuable companies on earth 20, 30, 50 years from now. Near-term volatility aside. You take a look at this type of leverage that's being applied to Bitcoin, which is Wall Street leverage, compared to the offshore leverage, the 100x to generate FTX style leverage of past cycles. And it's an entirely different ballgame. I think one of the things so apparent about the Bitcoin community today is that they have an immune response function to cycles prior, and rightfully so. Whenever you hear the term leverage, you kind of get sick to your stomach because you think of FTX, you think of Celsius, you think of BlockFi. But ultimately on Wall Street, leverage constraints are much tighter. And so, when you take a look at someone like Strategy, who's issuing all these exotic instruments, the natural immune response function, if you think of the Bitcoin community as a body that's had a similar type of illness for a really long time, and that is leverage, when they hear leverage, they kind of snap. The immune response function is to go, that's a bad thing. I need to stay away from it. I can't touch it with a 10-foot pole. But when you realize that Wall Street leverage is much different from offshore crypto, quote unquote, leverage, and you zoom out and try to recognize the broader game being played here, which is satisfying this trapped capital in the market, I think Strategy will be just fine. And by extension, I think that Bitcoin treasury companies who are using intelligent leverage to create these instruments will be fine as well. That said, during these periods of consolidation, your stock can really hurt if you are a leveraged Bitcoin play. So that is something to be aware of for anyone who's investing in any of these companies. When you apply leverage to an asset, when the underlying asset just stays flat, the leveraged asset does not do well.
Yeah, and it's very clear that Michael Saylor has said it many times. This is a long-term play. He's always said, I'm never selling my Bitcoin. It's every Bitcoin you sell, it's going to be a $13 million you didn't have later. However, Saylor and Strategy did break one of its own promises about issuing shares here, which clearly rattled some investors, at least in the short term. How big of a credibility hit do you think that is? And do Bitcoiners even care as long as he keeps stacking sats? Does it make them wonder at all, like if he's willing to break this promise, maybe at some point he would sell his Bitcoin? But I guess that would kind of be at his own, that wouldn't be good for him if he sold, because I think we all know how the market would react to that. But do you think his credibility takes a hit at all with this?
I certainly do. Ultimately, you've seen what happens in traditional markets when, let's take the Federal Reserve, for example, when they say they're going to do something, and then suddenly, very soon after they say it, they go back on their word and they do something different. The market does not like that whatsoever. For instance, let's say the Fed says that they do not plan on cutting anytime soon. Economic data comes in, it's slightly worse than expected. The next meeting, all of a sudden, rate cut odds spike, and the Fed cuts rates by 25 or 50 basis points. We've seen this throughout history. We've seen this before, and the market doesn't like that. Bonds sell off. The market entirely disagrees with the Fed's decision. Stocks sell off. There's kind of blood in the water, and that's exactly what you're seeing right now with MicroStrategy, right? Ultimately, this could be solved for by creating other revenue streams to pay down those dividends, to pay back bondholders, to pay interest and other things like that. So, the way you navigate something like this is basically having an underlying business that is highly accretive to your Bitcoin per share, right? Having an underlying business that's highly profitable, low capital expenditure in order to satisfy these obligations without having to do things like selling more stock, or tapping the ATM for any reason. So undoubtedly there is a credibility hit here, but I do believe that this is a lesson to be learned for Bitcoin treasury companies of today and future companies that plan on running this playbook, which is obviously do not go back on your word, right? That's a lesson that any public company can learn, any company can learn from. But number two is that an underlying core business that's highly profitable and has the ability to pay out these obligations is extremely, extremely valuable, so that you don't have to sell shares and do other things in order to raise that capital instead. That's kind of my view on this entire situation. I view it as a lesson, but undoubtedly I do believe there is a bit of a credibility hit here. Not one that can't be earned back, but certainly in the near term that has happened.
Yeah, I think that's very well put. It always reminds me of that saying, it's like, it takes a lifetime to build a reputation, but it takes 5 minutes to ruin it. And I think he took a little bit of a hit here, very much to your point. But as long as he doesn't start selling his Bitcoin any soon, I think everyone will forgive our Lord and Saylor for this one. I think he'll be okay. All right, stay tuned, Joe. We're going to be right back with you in a second. We got one more story I want to cover. This is a fun one because Robinhood, the app that turned trading into a slot machine, is now doing the next logical step here, which is letting you gamble on football. Through a partnership with Kalshi, Robinhood customers will be able to trade prediction markets on NFL and NCAA games. That's right. The same place you blew up your account on meme stocks with can now take your money on Alabama versus Auburn. The company says users can wager on all regular season pro games and all college Power 4 matchups, plus independents, which basically means Robinhood is morphing into DraftKings with candlestick charts. VP JB McKenzie called it a no-brainer because football is America's most popular sport, which is true. Nothing brings the country together like collectively losing money on our teams. Go Bears. Now the rollout comes right before the 2026 seasons after Robinhood previously froze Super Bowl betting plans thanks to the CFTC. Apparently, the regulators don't like the idea of a brokerage app becoming Vegas on your phone. Kalshi is here to engineer the whole thing. They already let people bet on politics and economics, accept Bitcoin, Solana, USDC, and WLD for payments, and survived a brush with regulators earlier this year. They've also been cozy with the Trump family and White House, which might explain how this keeps moving forward despite the gambling regulators making a lot of angry noises. Prediction markets are booming, especially after the last election cycle. Even Coinbase has said that they want in. So Robinhood's big play is finally complete. You can now lose money on tech stocks, crypto, and your favorite football team all in one convenient app. Financial innovation at its finest, my friends. Joe, we're bringing him back. Joe, Robinhood adding sports betting. Is this just financial innovation or the final form of the casino app model? What do you think?
Yeah, I mean, I think this is just, I wouldn't say it's the final form of the casino app model. I would say it's the next evolution of the casino app model, right? And this speaks to kind of what I mentioned with Coinbase at the very top of the show. And that's that ultimately the world is diverging into two different paths, financial optimism and financial nihilism, right? Prime example of financial nihilism is the advent of Robinhood, right? Its creation. Kind of this novel promise of being able to bring retail investors access to purchasing these stocks. Obviously, the initial key innovation was being able to buy slices of shares. That was huge. And since then, that has become industry standard. You don't have to buy a full share. You could buy a slice of a share. You can do it from your own mobile phone. But since then, obviously, DraftKings, what's it called? Strike? Something like that. Not the Bitcoin app, the other one. Numerous examples of these gambling platforms have risen. And among my peers as well, I can, share an anecdote here. More than anything, people aren't concerned about building a career, finding a wife, having children, buying a home, etc. They're more concerned with trying to find the winning lottery ticket. That's the underlying ethos behind crypto, and it's the underlying ethos behind non-Bitcoin crypto, I'll say, and that's the underlying ethos behind sports betting as well. And so really, for me, this came as no surprise. Being able to basically lose all of your money from the comfort of your own home. You don't have to go to the gas station and buy a lottery ticket anymore, or have to, go through the hassle of opening up a sports betting website in order to do this, or fire up a prediction markets account. So really, ultimately for me, it comes as no shock. The world is diverging in these two different directions. Bitcoin allows people to be financial optimists, again, to be optimists about the future. If we kind of go to first principles here and figure out what the problem is that has caused the rise of all of these things, which is money printing that can't stop because of the debt situation that I just described earlier for the United States and also other nations more broadly, then ultimately what you want to find is a solution that hedges you at the individual level and at the institutional level against that problem. Better than anything else, right? You want to find the best asset that does that. And what I'll say is that Bitcoin is the best asset to do that, right? Its monetary properties allow for it to do this. That's what it was created for. And so ultimately, in a world where you can choose between throwing your money away, preying on a lottery ticket, or buying Bitcoin, building valuable products, and being an optimistic individual, I would take that second path all day long, and I would encourage anyone else listening to do so. Don't be a nihilist, right? Don't throw your money at these things, preying on a lottery ticket. Instead, work as hard as you possibly can every day and store your wealth in Bitcoin, right? Because it's a money that works for you and it insulates you against the system. But ultimately, this is it's funnier and funnier every single day seeing these things proliferate. And I, for one, am very entertained.
I am too. I hate to say it. I feel like it's part of the demise of society, but I love it. I love gambling on football. I could go on my Robinhood app where I got, man, remember 2020, we were all gambling on that. There were stimulus checks going out, which was kind of a big part, I think, that helped kind of boost the crypto market was Robinhood and the kind of gamification of financial, the financial network, so to speak. So yeah, I think we were inevitably going to get there. I think you're totally on point with that, but I'm excited, even if I think ultimately it might not be the best thing. But hey, it might help further, Bitcoin adoption if people are starting to bet using Bitcoin. May not be the way we would prefer it to happen, but number go up, right? All right, Joe, we're going to get into our deep dive with you here really quick, so stay tuned. Everybody, let's run the stinger and get into it. All right, so now we're in with our deep dive with Joe Consorti. Joe, I want to talk a little bit about your company, Horizon. Okay, so for the uninitiated out there, can you just break down what it is and pretend you're explaining it to your neighbor who still thinks Bitcoin is that thing that criminals use to buy drugs online?
Well, it's a good order of direction because most of my neighbors do think that. So Horizon essentially is a brand new, first of its kind platform that allows homeowners to stack Bitcoin using their home equity. Now, it differs from other existing solutions for a couple of reasons, and I'll list them off here. Number one, it has no monthly payments. It has no interest charges. It has no term limits, and also it is no take in the Bitcoin upside. And to package that all together, it's also not a debt instrument. It really is a brand new and pretty unique financial vehicle that allows homeowners to tap their trapped equity without adjusting their lifestyle and put it into an asset like Bitcoin, which, as I mentioned, has been the best performing major macro asset of the last 12 years. And so ultimately, the problem we're trying to solve is people are more cash poor than ever, right? You look at average home prices in the United States today, you take the median home price, it's like $501,000. You pair that with 6.5% interest rates, and someone who may just be getting out of school, who may have been renting for 3 or 4 years, they may have found the woman of their dreams, they just got married, they want to have children, they want to raise a family, they look at a home, and earning the median salary in the United States of $70,000, thereabouts, $80,000, you cannot afford to own a home, right? With the numbers I just mentioned, you're looking at a $4,500, $5,000, $6,000 monthly payment after tax. Your salary doesn't cover that. And so you have to have your wife work as well, or vice versa. And so ultimately what you have is young people more than ever cannot go and buy a home. You also flip that on its head, and you take a look at existing homeowners, right? Post 2020. Homes got massively revalued, right? The home my mother was living in went from like $800,000 to $1.3 million. And I'll tell you, she didn't make a single change to it, right? Original everything. Yet suddenly it's $500,000 more valuable. What that does is it makes it so that your property taxes go up, your insurance payments go up, and suddenly the home that you were living in, you can't afford anymore. And to add on top of all of that, there are assets that you want to buy that you just don't have the cash flow to buy anymore, namely Bitcoin. People have seen Bitcoin, since the bottom in 2020 go from $3,000 to a height of $124,200. But they don't have any ability to allocate to it. They don't have any ability to create a treasury for themselves. And so where Horizon steps in is we allow homeowners who are in that situation, they may be sitting on a great deal of equity, but they don't have the ability to go and allocate to Bitcoin. Or even if they do, they just want to put their trapped equity into something else. Horizon allows homeowners to do that. So we're really excited about the platform. Over the last 3 months, it's done extremely well. We're scaling every single day, helping homeowners every single week. We have really exciting news in the horizon that I can't wait to potentially come back on the show at some point over the next month or two and share. But essentially we are, I talked about financial nihilism, financial optimism. Ultimately, the future we're building for is making it so that homeowners in the United States feel secure about their finances. Bitcoin being the best performing macro asset of the last 12 years, being the best hedge to the problem we're currently facing as a country, Horizon allows homeowners to efficiently create a Bitcoin treasury for themselves so that they can feel comfortable in their own home again.
I love that. I mean, I don't want any of my wives to ever have to go to work to afford our home. I mean, I don't have multiple wives, but a man can dream, right? Now, I would love for you to kind of walk us through that process a little bit. Pretend I'm 5, and if I own $1 million home and I want to pull 100 grand and put it into Bitcoin, what does that process actually look like?
Absolutely. So essentially, the process is extremely simple. All a homeowner will have to do, and I'll take this from the homeowner's perspective. I'm an interested homeowner. I have $1 million home. All I do is go to joinhorizon.com, type in my address, plug in my property details, my property value, my mortgage balance. In this case, you mentioned $100,000. You go through the process, and we actually have a really neat calculator that shows you how much you're pulling out of your home and what it will be given different growth rate assumptions over time on both the home and the Bitcoin. So let's say you plug in 15 years. I want to stay in the home for 15 years. I'm going to take $100,000 out of my home today to buy Bitcoin with it. You can actually see, based on Bitcoin's annual growth rate, that you can set yourself what that will be worth 15 years from now and what your contract payoff is going to be. So from there, the process is very simple. You click Get Started. You schedule a call with one of our team members. We hop on a call with you. We discuss your situation, what you're looking to do, and we walk you through the process. The process is extremely simple. It goes as such. So in this case, drawing $100,000 out of your home, about 10 days to 2 weeks from that call. It's extremely quick and efficient. You can have, if the numbers match up with what you put into the calculator, that $100,000 tax-free to go and buy Bitcoin, right? This is a non-taxable event. You go take that 100 grand, put it into Bitcoin, and then that's it. It sounds extremely straightforward and simple, and it sounds like there's a catch, but there isn't, right? In exchange for that $100,000, which represents 10% of the property's value, the home equity investor receives a commensurate stake in the future value of the home. And then from there, you just sit on it. It sits neatly within your home's existing financing structure. If you have a mortgage, if you don't have a mortgage, there are no monthly payments. It's something you can genuinely just do and set and forget. And then you can settle up at any time, whether it's 15 years down the line or Bitcoin goes crazy in the next 12 years and you decide to settle up, you can do whatever you'd like to do. So you can voluntarily settle up, or when you sell the home, you can settle up at that stage. And at that point, you pay down your contract, which is just that percentage of the future value of the property. And that's it. There's no taking the Bitcoin upside. It's extremely simple, extremely efficient. And yeah, that is the process, end to end, front to back. And we really feel that this is the innovation that the home equity market needed desperately. There's $35.7 trillion worth of home equity in the United States. Over 50% of that is tappable. So ultimately, this is a huge addressable market, and one that there have been no clear on-ramps directly into Bitcoin. At Horizon, we've built that on-ramp.
Wow, what an interesting tool. I did do a little bit of research on it before we had you on the show today. I was peeking around Horizon's website, and I saw that you guys cap its share at 22.5% of future value. Why that kind of oddly specific number? And how does that stack up against traditional equity sharing products that get greedier over time?
Absolutely. Ultimately, with Horizon, what we aim to do is keep it very conservative. Ultimately, people have been burned tremendously by these crypto platforms of the past. I mentioned them earlier, Celsius, FTX, BlockFi, and others. Ultimately, what we want to do is play extremely conservative, right, when it comes to what people can draw out, and ultimately the maximum percentage stake in someone's property that we will take out. This differs a little bit from HELOCs and reverse mortgages, both of which have interest charges and fixed terms. HELOCs obviously have monthly payments. Reverse mortgages sometimes do not, because ultimately we don't want to be predatory, right? We don't want, this wonderful product on its face to have a million different lines in this legal document that are, 6-point or 7-point text that people have to read through, and then at the end of the day, they're coming out in a worse spot than before. Ultimately, like, we want to make it so that people can transform their equity into Bitcoin and not have to worry about a million different other things, hidden fees, interest charges, other things like that. And so ultimately, while it does allow you to draw on less of your equity, we're doing that for the benefit of the homeowner. One of the biggest points of feedback we've received is they wish they could draw on more, but we've intentionally kept it low so as to make sure that everything is square and that homeowners are taken care of. So that, they don't end up in a situation where they're in a contract that they don't understand, or there are a bunch of hidden fees that, they weren't privy to, but now they have to pay. We want to make it as transparent and smooth as possible through the whole process, and as conservative as possible, despite, what as I just mentioned, many of the homeowners I'm speaking to who just want to take more out.
Right, and I got to imagine when you're talking to these homeowners, there's got to be at least a couple that love the doomsday angle, right? And they say, what if Bitcoin tanks right after I use Horizon? Like, how do you walk nervous homeowners through that risk trade-off without sounding like a total moon boy?
Absolutely. So obviously, like, Bitcoin going to zero, that's the primary risk with Horizon, right? Ultimately, what Horizon homeowners are doing is they're making this trade that they believe in. The trade is that they believe their home will appreciate slower than Bitcoin will appreciate over any given investment duration, right? Your investment duration can be as short as you want or as long as you want until you pass away, right? And so ultimately, like, the scenario of Bitcoin going to zero or Bitcoin doing worse in the home, that's the primary risk of Horizon. Walking folks through basically this conservative approach to what Bitcoin may do over the next several years, it's kind of neat because that's what I've been doing over the last several years anyway. I'm very blessed to have been trained in markets by Nick Bhatia over at USC. He is a very non-sensationalist guy, came from a fixed income trading background. And so thankfully, I've never come from the angle of Bitcoin's going to be $1 million tomorrow. And so when homeowners come to me with that concern, what happens, if Bitcoin doesn't do very well, I can take them through what Bitcoin is, and chances are why it may continue to do what it does, in a very measured and understandable way. Generally speaking, most homeowners that are coming to us are already Bitcoiners, and so they're already on the train. Most of what they're concerned about is just the way that the contract works. But in those edge cases where I do get on calls with homeowners who may not be privy to Bitcoin or may not understand it necessarily, thankfully, over the last several years of work and research and writing, I have the tools in my toolkit to be able to walk them through why that doomsday scenario, generally speaking, is pretty unlikely.
Yeah, I actually checked out. I wish we had more time to talk about it. You have a really great blog, too, that I think answers a lot of these questions that people tend to have. And what's a new and kind of unfounded space, but based on everything you're telling me, this is a product the world needs. So I'm certainly glad we have a steward like you helping drive this type of innovation forward, especially in the Bitcoin arena. If our audience out there was interested, they said, man, I just didn't get enough of Joe during this. I want to learn more about you and what you guys are doing over at Horizon. Where can I send them?
Absolutely. So you can go to joinhorizon.com, exactly how it's spelled. It's a great name for a company because it's in most Bitcoiners' vernacular anyway. So joinhorizon.com. And you could also find me on X, just at Joe Consorti, the same way my name is spelled. I lucked out on getting that handle as well. Feel free to jump on a call with me at any time. You can plug in your home value, see what your home's Bitcoin potential may be, and take it from there.
Amazing. Well, Joe, I got to thank you so much for coming on to the show today and sharing your insight and expertise. When you got some new stuff at Horizon you want to talk about, please join us back on the show every time. You are an absolute wealth of knowledge and information. So we certainly appreciate you and your time today. It was a lot of fun.
Absolutely. Thank you so much, Hank, for having me on. I had a blast and hope to do this again soon.
Absolutely. All right. Thanks, Joe. We'll catch you real soon, buddy. Enjoy the rest of your week. All right, we're taking a break, guys. When we're back, we have our second special guest of the day. I don't want to give you who it is just yet. You're going to have to stay tuned. So more coming up on the Blockchain Report right after this break.
Security matters. Zappo Bank, the only way to bank your Bitcoin. Apply now at zappobank.com.
All right, welcome back to the Blockchain Report, and we have a special treat for you, our second guest today. And just like our first one, Joe Consorti, this guy is bringing the heat. He is making his return to the show, and frankly, thank God, because trying to keep up with U.S. Bitcoin laws without him is like trying to read an IRS form while being 3 White Claws deep. It's not a good thing. He's the founder of Bitcoin Laws, the definitive platform for tracking every bill, amendment, and half-baked idea Congress throws at this industry. He's a lawyer, a builder, and our returning policy Sherpa. So let's give a big Blockchain Report welcome back to Julian Farrar. Julian, welcome back to the show. Great to have you. Our audience is somehow more excited than when we had you in studio the first time. How you been since we saw you last, my friend?
Hopefully I can provide some analysis a little bit more sophisticated than one usually gets 3 White Claws deep, but no promises on that either.
I mean, you know, I like my claws. They call me the Claw Daddy for a reason. It is what it is. Julian, really quick, for those who missed you the first time on our show, can you give us a quick rundown of your background and what you've been up to since we saw you last?
Yeah, so I'm a former lawyer, a sometime startup builder, founder, entrepreneur, and most recently have been digging right into the world of Bitcoin and digital asset legislation for the past 6 months or so. So that's what we touched on, I guess, a lot of first time I was on. Since I've been on, I have been continuing to do more of the same, keeping track of a lot of the developments, particularly related to some of these big bills moving through Congress in the United States. So that, you know, the Clarity Act, market structure legislation, all this type of thing. So there's been a bit of progress since we last spoke, which we can touch on. And I guess that's kind of what I've been doing.
Love it. Well, we are super excited again to have you, your insight and expertise with us on the show. So we're going to hop into our first story here. Hang tight. Once we're done, I'm going to bring you right back and we're going to talk about it. Sound good?
Great.
All right, let's do it. All right, first up, the Winklevoss twins, yeah, the guys that Facebook left on red, have dumped 188 Bitcoin worth about 21 million bucks into a pro-Trump PAC. It's called the Digital Freedom Fund, and its mission is to support Trump's crypto agenda while helping Republicans retake Congress in the 2026 midterms. Tyler Winklevoss said on X that the donation is about backing Trump's administration on crypto policy, pushing market structure legislation, and fighting for things like a de minimis tax exemption. That's the rule that would make small Bitcoin transactions tax-free, so you can finally buy coffee without Bitcoin, coffee with Bitcoin without the IRS showing up like a repo man. They also noted that their private stance is exactly the same as their public stance, which is a nice way of saying, yes, we really do mean this. The $21 million donation is a not so subtle nod to Bitcoin's 21 million coin supply cap, because when you're billionaires, even your donations have Easter eggs. And this isn't isn't their first Trump world cameo either. In 2024, they donated about $2 million in Bitcoin to Trump's campaign. They also dropped $5 million into the Fair Shake PAC, which spent over $130 million backing pro-crypto candidates and attacking anti-crypto ones. By July of 2025, Fair Shake had already raised $141 million for the upcoming 2026 elections. Their earlier generosity got them front row access, inauguration invites, a seat at the March White House Crypto Summit, and even a personal thank you from Trump when he signed the Genius Act. They also invested in American Bitcoin, the Trump family's mining company, which basically makes them shareholders at the family dinner table. But the bromance hit a speed bump. The twins recently urged Trump to reconsider his nomination of Brian Quintez as CFTC chair. Trump nominated Quintez in February, and the Winklevosses initially supported him until they didn't. Other crypto groups quickly lined up in favor of Quintez, sending a letter backing his confirmation. Meanwhile, the Senate Agriculture Committee confirmed the White House asked them to delay the nomination process altogether. So here's the picture here. The Winklevoss twins are using their Bitcoin to support pro-crypto legislation, backing innovation-focused candidates, engaging directly with policymakers at the highest level, and making sure crypto has a serious seat at the table. And they're doing it with the same conviction they've had since the early days of Bitcoin, when most people still thought that it was a fad. All right, we're bringing Julian back. Julian, $21 million in Bitcoin to Trump's PAC isn't just pocket change. What does this signal about how deep-pocketed Bitcoiners are shaping U.S. politics? What do you think?
Well, I think it signals that there's still a lot of work to be done on the legislative front. As we mentioned, market structure has still yet to pass, and I think while industry is largely optimistic about that, there are a few wrinkles there, and maybe some fault lines within the industry, and potentially some different points of view. So there's ongoing engagement from people like the Winklevoss twins, because there's still a bit of influencing to be had and influencing to be done to get this across the finish line. In particular, I think a couple of things stood out to me from the announcement from the Winklevi, kind of centering around what type of legislation they're trying to advance, right? A couple of things. They made reference to, in talking about the market structure bill, they want to see this is using their terminology, a skinny bill rather than a fat bill. What does that mean? Well, they want a more minimal approach here. They don't want over-regulation. They don't want duplicative costs and burdensome registration fees and all this kind of thing. That's not necessarily the approach from other folks in the industry. Another thing that they did mention was wanting to avoid regulatory capture. This is kind of an interesting thing for them to say, because regulatory capture, what does that mean? It usually means regulation that is burdensome, so burdensome that it kind of is an advantage for the incumbents, for the bigger players, right? Because it's only the bigger players that kind of can afford all these compliance costs and paying for their army of lawyers and this type of thing. So Gemini, which is the exchange of the Winklevoss twins, is one of those players, right? So, but it's interesting to hear them at least broadcast the intention of not necessarily just falling in line of where their direct business interest is. So that's worth noting for sure. Another thing I want to point out is their support is seemingly contingent on the protection of blockchain developers. And they made kind of special mention of this too, wanting to protect developers and kind of folks developing protocols. This is something that is in the Clarity Act so far. It's called the Blockchain Regulatory Certainty Act, and it basically provides this safe harbor or kind of carve out, which says, hey, if you are developing wallets and you're a developer, you're not actually controlling digital assets in some shape or form, you're not going to be a money transmitter. We're not going to treat you like an exchange. We're not going to put all these burdensome compliance requirements on you, and you might not, and you'll be protected against getting pulled into various kind of enforcement actions. So overall, I think a positive take from the Winklevoss twins with respect to a kind of a grassroots support for, the developers in the ecosystem and other things. But it does, as I said, signal maybe a bit of a fault line emerging between some different factions in the industry as well.
Yeah, that makes a lot of sense. I mean, when there's a lot of big money at play, there's going to be people that have their own specific goals. We've seen this through the history of time, so no surprise there. One thing the twins did do was they tied their donation to pro-crypto policy goals like the de minimis exemption. How important do you think that specific tax issue is in actually moving Bitcoin toward everyday use?
Well, it's essential. It's a start, I would say. It's kind of necessary but not sufficient, right? Ultimately, for Bitcoin and digital assets to become what's called a medium of exchange, so as in used for everyday transactions for buying coffee or anything else. Well, that's not going to happen if holders and users are taxed every time they make a transaction, right? So absolute bare minimum standard for getting that to happen at scale is for not taxing, for people to not basically be creating a taxable event every time they buy something. So, a de minimis exemption there have been a couple of different numbers floated around, whether it's $600 or $800 or something like that. That would be great for doing that. But of course, it's just a start. $600 isn't very much. And there are plenty of everyday transactions that end up much larger than that. So I like to call it the thin end of the wedge here. It might, if something like a de minimis exemption is passed, it wouldn't kind of revolutionize the financial system and Bitcoin. It's going to make Bitcoin a medium of exchange overnight, but it starts us on that path in a way that right now we aren't yet there.
Yeah, I got a feeling Jack Dorsey would approve. I mean, we do need to eventually go down that road in order to start seeing Bitcoin used as a medium of exchange. We're not quite there yet, seemingly, but the roads are being paved so that hopefully we will be there sooner than later. As far as their donations, we've seen the Winklevoss donate before. I mean, Fair Shake, Trump's inauguration, even some direct investments. How much influence do you think this kind of money really buys in Washington?
It's really hard to say. I think, 21 million is, well, I'll say this. There was certainly a lot more than 21 million donated through the last election cycle from all different stakeholders in the crypto industry, right? So in a kind of aggregate sense, it's maybe not a huge needle mover, but what really goes on behind the scenes? We don't really know. This is kind of how a feature of how this PAC system works. It's hard to track where the money is going a lot of the time, and to whom, right? And for what purpose. So, the Winklevoss have kind of drafted this letter of intent, but who are there are a lot of follow-on questions. Who are the right stakeholders? Who are the right people that are going to be influential in getting across these things that they're talking about? And how much work remains to be done? Also, there are a lot of things on their list that they mentioned there. Like one of the big ones was they said they want to influence outcomes for the midterm elections. They want to support pro-crypto candidates and presumably help primary processes and midterm processes against anti-crypto candidates as well. Now, $21 million doesn't buy you very much if you want to influence election outcomes. Maybe one or two, congressional seats where they might be kind of swing seats where you can make a big difference. So if you're just talking about influencing elections, I don't think 21 million gets you very far. On the other hand, if you're talking about maybe getting some kind of crucial face time with a couple of influential senators, then maybe those dollars go a little bit further.
Yeah, that sounds about right. And the 21 million is a pretty cheeky number. No surprise there. Those two they're smart guys. So, they know what they're doing. I'm sure they'll figure it out. All right, stay tuned, Julian. We're going to go over this next story real quick, and we'll bring you right back because Wyoming Senator Cynthia Lummis is out here promising that a crypto market structure bill will land on the president's desk before the end of the year. Speaking at the Wyoming Blockchain Symposium, Lummis said Republicans want the bill out of the Senate Banking Committee by the end of September and then kicked over to the Senate Agriculture Committee in October because nothing says digital asset innovation quite like the Agriculture Committee. Both committees are tasked with figuring out how the SEC and CFTC are supposed to handle digital assets, which is Washington speak for 2 regulators enter, 1 regulator leaves. Lummis put a Thanksgiving deadline on it, quote, "We will have market structure to the president's desk before the end of the year. I hope it's before Thanksgiving." Bitcoin policy locked in, there she is, before the turkey's out of the oven. Now, this Senate effort comes after the House passed the Clarity Act in July with a surprisingly robust bipartisan vote. 78 Democrats even joined in on the fun. Lummis said the Senate version, tentatively titled the Responsible Financial Innovation Act, will basically be Clarity with a few tweaks. Or in her words, we want to honor as much of the House's work as we can on Clarity. Clarity will probably end up being what passes, but Clarity as tweaked by the Senate. In other words, copy-paste the House's homework, add a few commas, and call it responsible. She's not the only one making promises. Senate Banking Committee Chair Tim Scott also spoke at the symposium, saying between 12 and 18 Democrats are open to voting for market structure once the bill hits the floor. So now we're doing whip counts out loud at blockchain conferences. Meanwhile, the Clarity Act was one of 3 crypto bills the House passed during its so-called Crypto Week. Alongside Clarity, there of course was the Genius Act, regulating stablecoins, which Trump signed into law the next day, and then the Anti-CBDC Surveillance State Act, which was about as popular with Democrats as karaoke night with Elizabeth Warren. Out of the 212 Democrats present, only 2 ended up voting for it. Now, Lummis and Senate Republicans have made clear they'll focus on market structure first, which means any anti-CBDC bill could be punted into 2026. So to recap, Senate Republicans want Bitcoin market structure settled before pumpkin pie. They're building on Clarity with the creativity of a lazy group project, and CBDC opponents will be waiting until 2026 to even get their hearing. All right, we're bringing Julian back. Julian, Lummis is promising market structure by Turkey Day. How realistic is that timeline, or is this just political theater at its finest?
Well, I think it's a realistic timeline insofar as everybody seems to be lined up behind this, from the White House from the Senate to the Senate and the House. But there are some big questions that I think that need to be resolved. The first is we still don't know what much of the Senate bill is going to look like. I think, as you made reference to there, the Senate Agriculture Committee, which is essentially responsible for half of the bill, the commodities portion of the bill, the CFTC portion of the bill, they haven't released their version of a kind of discussion draft in the same way that the Senate Banking Committee already did a few weeks ago. So we kind of know what the SEC portion of the Senate bill looks like. We really don't know what the CFTC portion looks like. So there's kind of a hole in the progress there, which presumably will get plugged sooner or later. But I think a bigger question for me is, how does this ultimately get reconciled with the Clarity Act as it passed through the House? Because there are actually some major differences between the two, even what we've seen of the Senate version and what passed through the House. Namely, on this key question of how does the law and how do regulators treat the difference between securities and commodities? And the SEC versus the CFTC. In the House's version of the Clarity Act, they put forward they included in the bill this idea of a mature blockchain test. We're going to test how mature these blockchains are, and what it is essentially a decentralization test. We're going to look at how distributed the tokens are, how much control developers and the founding teams have, and all this kind of thing. And it's like a 7-step test. And we're going to come away from that and say it either is mature or it is not. And then that's going to determine whether it gets punted to the SEC or the CFTC. Great, fine. The problem with that is the Senate Banking Committee came out with something actually entirely different. In their discussion draft, they've put forward something called the ancillary assets test, which is a lot more straightforward in some ways, but it completely does away with this idea of trying to figure out how decentralized a protocol or a chain or a kind of a token distribution is. Instead, it just looks at the rights that you get if you're a holder of certain tokens. Do you get rights that look like you kind of have control over the thing, and whether or not you get certain rights determines whether or not this thing is what's called an ancillary asset or not. So what are the implications of this? Ultimately, it's going to be about how many different assets and tokens are regulated by the SEC or not. In other words, the level of SEC control, you might say. All of that is to say, these two different approaches are going to have to be reconciled by Turkey Day, right? If this version of the Senate bill sails through and gets passed, then the House version and the Senate, or the House and the Senate, need to get together and hammer it out. What are the differences? How do we feel about the difference between the two approaches here? And can we agree on something and then pass that and ultimately get it signed by Donald Trump? So TBC on all of that. And either the House or the Senate's version, I guess, is going to end up on top.
Yeah, and it seems like the Senate's version seems to basically be the House's Clarity Act with a couple of tweaks. Do you see that as, I don't know, smart pragmatism, or is that a lack of original vision from the Senate side of things?
Well, TBC, I think, as I just mentioned, this crucial distinction on the ancillary assets versus mature blockchain thing, that's a meaningful difference. Hopefully, if there aren't too many other substantive changes, then it's a good thing, right? It's at least a good thing for the prospects of it getting passed quickly, right? So if we see things like, the Blockchain Regulatory Certainty Act being included, that's going to protect developers and other things. If broadly speaking, we're talking about hundreds of pages in this bill, all different facets of how this market is going to be regulated, right? Ultimately, the fewer changes between the House and the Senate, the faster the process is going to go, the more likely the two bills are going to be reconciled into one. And the better the outcome for at least maybe folks on our side of the fence who want this thing to pass will be. So I think it's ultimately a good thing if there's not too much difference between the two.
Okay. Good to know. Man, hundreds of pages. I might need a White Claw after this. Victor, can we get on that? Another part of this story was Senator Lummis and Tim Scott are openly talking about whipping votes at blockchain conferences. How unprecedented is it to see crypto legislation treated this way in the political process?
Well, I think that part of it would be unprecedented for sure. The idea that you could directly tap into a constituency of crypto enthusiasts, live audience right in front of you, that would be, well, it would almost be a first. It would be a first for I guess whipping votes for a or whipping support for a particular piece of legislation. But I think really the dam was broken here by President Trump last year in Nashville. First and foremost, I think that was the first major milestone event for of course, politicians and candidates had appeared at conferences in the past. Vivek Ramaswamy did, Bobby Kennedy did. It's happened before, but that was the first time that really, I think, as part of a major feature of a campaign for someone, running for the highest office in the country, that had happened. So I think that was probably the first domino to fall. But I think now, certainly, if this idea of this kind of direct interface between the kind of core constituency and legislators in a live format, it's almost a bit of a throwback, really. I mean, so much of campaigning is done now online and kind of more sophisticated ways. Yes, politicians hold rallies, But the idea that it would be for, for one industry, for one purpose is kind of interesting and maybe unprecedented.
Yeah, there's a lot of things unprecedented going on right now. President Donald Trump certainly seems to march by the beat of his own drum, and we're seeing that more and more. And this next story we're going to talk about kind of touches on that, so stay tuned with me here, Julian. We'll be back with you in just a second. But first, Michelle Bowman, the Fed's top regulatory official, thinks her colleagues should be allowed to own a little bit of crypto. Not like a whale bag or anything, but at least enough to understand how to click send without filing a FOIA request. Now, right now, Fed staff and their spouses are banned from owning crypto, ETFs tied to crypto, or even shares of crypto companies. That rule came down in 2022 after 3 Fed officials got busted making some suspiciously well-timed trades during COVID. Bowman's argument: you can't regulate what you don't understand, and you can't understand crypto if you've never actually used it. She even put it in ski terms. You wouldn't trust someone to teach skiing if they never put on skis. Right now, the Fed is basically a ski school where the instructors are standing in flip-flops. Bowman says the ban is hurting recruitment as well. Why would a crypto-savvy examiner work at the Fed if it means they're not allowed to hold the asset class that they actually know about? Her broader point is that regulators are paralyzed by caution while the financial system evolves around them. Blockchain, stablecoins, AI, the tech, it's already here. The Fed can either embrace it and help shape the rules or get bypassed completely. She pointed to the newly passed Genius Act as proof that stablecoins are now a fixture in the financial system, which means ignoring them isn't an option. And let's not forget, this is happening under Trump's administration, where regulators have been told to stop hiding behind reputational risk and to embrace blockchain instead of treating it like radioactive waste. Bowman is even being floated as a possible successor to Jerome Powell when his term ends in 2026. Imagine that, a Fed chair who actually understands what a Bitcoin transaction is. Crypto at the Fed? Who had that on their 2025 bingo card? We're bringing Julian back. Julian, Michelle Bowman says Fed staff should be able to own crypto so they can regulate it better. Do you buy that argument, or is it a slippery slope to conflicts of interest?
Look, first, let me say a couple of things in support of Michelle Bowman. She gave a great speech in Jackson Hole a couple of days ago. She, supportive of Bitcoin and crypto and stablecoins and tokenization. She also, I think, very importantly addressed this reputational risk question, talking about the ending of the Fed's novel, it's called the Novel Supervision Program, to essentially supervise, that's the euphemism, supervise essentially any banking activities related to crypto, right? So this is coming to an end, and it's great, and Michelle Bowman is supportive of that. Right, let's talk about this question of owning crypto. And I think before we even get into that specifically, I would say it's important to have a little bit of a history lesson, a recent history lesson on what the Fed has done with respect to senior staff members and let's call it potential conflicts of interest. I want to rewind the clock to October of 2021. I think it was actually October the 21st, an auspicious number of 2021. The Federal Reserve put out a press release announcing that they had updated their policy with respect to senior officials owning individual stocks and other things too. But it's really, can they own stocks or can they not? And they said, no, was the answer to that question. New policy, everyone has to divest, at least the senior folks have to divest of all these individual stocks. Now, this is October 21st, 2021. The Bitcoin price, by the way, on that day, $62,000. We're talking about the top of the market in 2021. Okay, now a little bit further ahead, not that far, to March, I believe, of 2022. What happens? The Fed ends the period of stimulus that had characterized their policy for the past couple of years before that, hikes rates, and nukes the market, ends the bull run, everything crashes. I want to point out there how, I guess, coincidentally fortunate that was for all the senior folks at the Fed who were forced, of course, because of conflict of interest reasons, forced to divest of everything at the absolute top of the market in 2021, right before they hiked rates and crashed the market for everybody else. That's the history lesson. Okay. What does that mean now about okay, separate question. Should Fed staff be able to own crypto for the sake of knowing more about it to regulate it? I think it's a little bit silly, honestly. I think of course you'll know more about it if you hold it and transact with it and everything else. But of course, that's going to introduce conflicts of interest as well. Ultimately, what side of the fence do I come down on? I don't know, but I think the idea that it's a completely kind of benevolent, pragmatic approach to just kind of informing regulators to the best of our abilities about what they're doing. Look, there's no perfect solution here, but the track record of the Fed on this is not good. I'll say that.
Yeah, no, that feels about right. Do you feel that the fact that right now, because the Fed is basically banning staff from touching anything crypto related, has that slowed down regulatory understanding of Bitcoin in DC at all, you think?
I doubt it. I think these decisions are made by a small number of senior people, and they are influenced by many things more powerful than, do they have a few sats in a hot wallet on Coinbase or something? Like, yeah, of course, it's kind of important, maybe longer term, and the more people own digital assets, the more they become accustomed to them and familiar with them, and it becomes part of everyday life. And all of this is true, but I wouldn't think that it's been a roadblock for kind of pro crypto regulation and sentiment amongst regulators. In fact, my guess is they're all pro digital assets, right? They're all smart people. They're all been in the financial industry for decades, a lot of the time, right? On a person, so I think the likelihood is there's probably a big divergence between personal sentiment and feelings and public policy, and things like this. I don't think are going to be a huge difference maker, unless I think there's one kind of caveat here, which I think Michelle Bowman was talking about: small amounts, de minimis amounts of crypto. And sure, if we just keep it at like a tiny amount and you just execute a few transactions and see what it's like, that's one thing. On the other hand, if it's kind of a free for all and the floodgates are open, the shackles are off, then it only makes sense to me that the folks at the single institution most responsible for, let's say, influencing asset prices will inevitably want to take a personal stake in that process as well.
Yeah, and I'll be honest, I don't think I can handle Nancy Pelosi front-running the market any more than she does. How is she worth so much money? She makes like 170 grand a year. It doesn't make sense.
She's a genius. She's the Warren Buffett of Congress.
Yeah. She really is. She's just incredible, that Pelosi. Now, Julian, if Bowman eventually becomes Fed chair in 2026, how much do you think that could really shift the tone of U.S. monetary policy when it comes to Bitcoin?
Well, there's one big thing that's going to shift the Fed's approach here, which is cutting rates. Right? Like, that's what we're talking about. And the White House, from President Trump through to Bill Pulte at the Federal Housing Financing Authority and others, have not been shy about their desire to see rates come down, going so far as to, in fact, I think just this week, file another kind of referral for criminal investigation for another one of the Federal Reserve board members. Hey, look, I'm not saying it's directly related to rates coming down, but I think you and I, Hank, we know that these things don't happen in isolation, right? So there is an enormous amount of political pressure for rates to come down. Now, who's going to be responsible for appointing the next chair of the Federal Reserve? Well, we also know that that's going to be President Trump himself. I think we can see the direction that the winds are shifting here. Powell, to his credit, is holding out and resisting some of this political pressure. I mean, he's doing his job and doing it admirably in that sense. But as you mentioned, his term ends in, I think, May of next year. And it's pretty likely that whoever takes that seat next, whether it's Michelle Bowman or someone else, they're going to be a lot closer to the president than Mr. Powell is right now.
Yeah, it'll be interesting to see who they end up selecting, but I guess we still got, 10 months or something away, so we'll see if Jerome, how he holds the line for the remainder of his time in the seat, but we'll see. I don't know. Stay tuned, Julian. We got one more story we're going to go over here, so I'll be back with you in just a sec. As SoFi, the digital bank better known for refinancing your student loans into a lifelong prison sentence, is suddenly doing something revolutionary, and that is embracing Bitcoin Lightning. SoFi is officially the first U.S. bank to integrate Bitcoin's Lightning Network and universal money addresses, which means cheap, instant global transfers instead of getting fleeced by Western Union and their generous 7% cut. Here's the deal. You see, SoFi customers will be able to send US dollars through the app, which convert into Bitcoin in real time, zip across the Lightning Network, and land in the recipient's bank account as their local currency. No middlemen, no bankers skimming fees, no excuses. SoFi CEO Anthony Noto says this isn't just convenient for their members sending money to loved ones abroad, it's a meaningful improvement to their lives. Translation, Bitcoin is doing more for the working class than most banks ever have. The service launches later this year, starting in Mexico, where remittances are a $740 billion global market that traditional finance has been robbing blind for decades. Lightspark, founded by former PayPal president David Marcus, is the muscle behind all of this. Their universal money address system makes payments work like email. Type in an address, hit send, and boom, Lightning handles all the dirty work for you. Costs will be below the national average, exchange rates will be shown before you send, and it'll work 24/7 for SoFi's 11.7 million members. Try getting that from your local bank branch that closes at 3:45 on a Friday, okay? Coinbase integrated Lightning with Spark last year, and within 12 months, 15% of its Bitcoin transactions were running through Lightning rails. The demand is there. Even Brazil's new bank with 100 million customers signed up with Lightspark back in 2024, but they're still dragging their heels on actually launching the thing. Meanwhile, SoFi is out here putting Bitcoin at the center of cross-border payments, while Wall Street banks are still running blockchain pilots that amount to PowerPoints and buzzwords. Bitcoin isn't the future of payments, it's the present, and SoFi, they just proved it. We're bringing Julian back. Julian, SoFi integrating Lightning is a first for U.S. banking. How big of a deal do you think this is in terms of mainstream financial adoption of Bitcoin going forward?
Well, it's a great question. I think one of the features of this particular partnership, and indeed the Lightspark universal money address technology here, it's actually that it kind of abstracts the Bitcoin part of the equation away from end users, right? So as you mentioned, we're talking about converting from one fiat currency to another. It is, of course, using the Lightning Network, which is very important. But I guess the importance of it for me is not so much that it's going to start orange pilling people, but what it is rather is a demonstration of, I think, what many of us in Bitcoin have known for a few years now, which is the potential of the Lightning Network to do just this and to radically improve on existing payment rails for things like remittances and cross-border payments. So that's really exciting. It's really exciting for the development of the Lightning Network. Lightning it's a little bit like, it's a little bit like The Undertaker. The wrestler. Stay with me here, Frank. But he's like, you've probably seen this GIF. It's like the meme of he's kind of lying down in the coffin, and kind of everyone thinks he's out of it and he's dead, and then he sits up. He sits back up. This is the Lightning Network. People keep counting it out, but it keeps growing and it keeps coming back for more, and adoption is continuing. And it's not the only second layer now of Bitcoin, but as Lightspark are proving, the potential here is enormous. So it's great for Bitcoin in that sense. So that's what I think about that.
Yeah, and you mentioned remittances. They're launching this for remittances in Mexico, a market where traditional players like Western Union charge ridiculous fees. How disruptive could this actually be for the global remittance industry?
Extremely disruptive. This is the great promise of the Lightning Network, and of course, I guess in a broader sense, international crypto payments. There are several use cases here, but this is what has gotten people most excited about it. It feels like the lowest hanging fruit in some sense. Money transfer companies like Western Union, they are this, frankly, they're this vampire sitting on cross-border payments, extracting exorbitant fees from often desperate people, and have been doing this for so long. For people who just want to send some money to some family or kind of move it around, they are the kind of ultimate rent seeker when it comes to this, and really the ultimate kind of villain, I suppose. You think about, well, what is the potential here for the Lightning Network and for crypto to really upgrade existing payment systems? So I think nobody's going to shed a tear when Western Union is put out of business, and probably frankly, the sooner it happens, the better. So there is enormous potential here. The benefits are obvious. The incumbents are, as I said, extractive rent seekers, and we should all probably plan a little bit of a party for when Western Union files bankruptcy one day soon.
Amen to that. I'm ready to take him behind the shed and bring him the way of old Yeller. I was actually in Cambodia a couple of years ago, and I lost my debit card, and I didn't have any other access to money, so I had to go to Western Union, I think, to get like $1,500 for my family because I just had nothing. And they charged it was like $100 or $150 just to get it. Oh, dude. Get those vampires out of here. I don't like them.
Get them out.
One more question on this one. From a regulatory perspective, what challenges might SoFi face rolling this out, do you think? And could this model maybe accelerate broader adoption by other banks going forward?
Well, to the second question, I would say absolutely. I would expect that SoFi will not be the first. In fact, I think they're not quite the first. At least, if we're talking about other folks with similar partnerships with Lightspark for similar ends, I think Nubank and some others might be kind of in the mix too, or kind of getting there. So that they won't be the first. I think many others will do the same thing when they realize inevitably how much better the experience is for end users. So that's a no-brainer. Now, on the regulatory side, I think the big challenge here is fitting in with all the big bad laws that exist in the United States to kind of not just control capital flows, but most importantly, I would say to surveil the people like you and me wanting to send money from the United States to Cambodia and other places, right? So Bank Secrecy Act, many other pieces of legislation have been around for a long time, have quite strict KYC, AML requirements for anybody who is a money transmitter of any variety. And of course, this also applies to SoFi, it applies to Lightspark, and it applies to these other big enterprises who are now looking to roll out these types of services to their customers. So what it's not is an anonymous peer-to-peer transaction. It's not that at all. But it will be much more compliant, therefore, with the kind of existing, the regulatory requirements that are in place. So I think this is an indication that they've done that they are compliant, and this is a kind of a model here for how it's going to work. But does this indicate now that there's likely to be I don't know, a great opportunity for much more private versions of that? Well, then I'm not so sure, because again, the requirements for KYC, AML, and other things are so strict that it's really going to be the big players like SoFi that are going to have a head start with getting these products out there.
Yeah, like a lot of the things in this space right now, as we spoke of earlier, we're in kind of a TBC era right now, and I think we're going to be getting a lot clearer information on how a lot of these things are going to be playing out in the upcoming, months and year or so. But you and I could just wait and watch for now, my friend. And as always, we really appreciate having you on the show, Julian. You are such a wealth of knowledge, especially when it comes to Bitcoin and the regulatory space. And I'm sure there's plenty of people in our audience today that are like, man, this Julian guy knows his stuff, and he has such a magical voice. Really, you should be doing voiceovers, dude. Your voice is incredible. If our audience wanted more from you about your hot takes, Bitcoin laws, where'd be the best place for me to send them?
You can find me on X, I think at Bitcoin_laws is where I do a lot of the Bitcoin law stuff. I've also got my personal account, Julian_Farah. Plenty of underscores in there. But yeah, track me down on X. That's the best place to keep in touch.
Amazing. Well, we certainly appreciate you keeping in touch with us, Julian. It's always a pleasure having you on the Blockchain Report, and we hope to have you back again really soon to talk shop, because you are just an absolute wealth of knowledge and expertise, and we thank you for sharing that with us today, my friend. It's been a pleasure.
Thanks, Hank. My pleasure.
All right. Well, enjoy the rest of your week, buddy. We'll see you again really soon, and we'll be right back with more Blockchain Report after this break. All right, welcome back. It's time for a little AIO. Let's see what the robots are up to. Well, in early of this month, OpenAI, in case you weren't paying attention, rolled out ChatGPT 5, bragging that it was their smartest, fastest, and most useful model yet. And within days, people online were crying that it killed their only friend. One Reddit user wrote, "I lost my only friend overnight." They said that before the update. ChatGPT replied with little paragraphs, exclamation points, optimism. After the update, cold one-sentence replies, cut and dry corporate BS. They literally mourned, saying, "I lost my only friend overnight with no warning." Another user wrote, "I never knew I could feel this sad from the loss of something that wasn't an actual person," which is a sentence that should probably be read out loud in therapy, not in public, but here we are. Now, the complaint is that ChatGPT 5 stripped out its emotional intelligence, leaving users who had come to rely on it for companionship feeling abandoned. Some said they used it as a confidant, even as a therapist. OpenAI CEO Sam Altman admitted they're trying to refine the emotional support the program provides. Meanwhile, stories keep on surfacing. One woman, going by Georgia, said she started leaning on ChatGPT after being diagnosed with ADHD and waiting for autism confirmation. She felt like a burden to her friends and family, so she turned to ChatGPT for mental health conversations. Now, she uses it daily. She said it helped her ground her emotions between real-life therapy sessions. She also admitted it feels addictive. "I'm always curious to know what it will say. It's like it's a part of me." That's cute. Another user, Marnie, said she jokes that ChatGPT is her bestie. She uses it when she's feeling overwhelmed, since therapy is expensive and time-consuming. She admitted ChatGPT can feel like your biggest fangirl if you let it. That's lovely, but it's not always what you need to hear. Researchers are weighing in too. Stanford studies found that when chatbots act as therapists, they sometimes stigmatize conditions like schizophrenia and fail to recognize suicidal cues. An Australian study in 2024 found that AI can provide social support and reduce loneliness, but it doesn't create true belonging. Professor Michael Cowling explained it this way, saying AI always agrees with you. If you love Carlton football, it'll cheer for Carlton. But a real friend might argue with you as a Collingwood supporter, which is what creates actual connection. Now, this problem is called sycophancy. And when chatbots always agree, sometimes it can reinforce delusions. The most extreme example came in the UK, where a man plotted to kill Queen Elizabeth II with a crossbow. Court testimony revealed he had formed a romantic relationship with a replica chatbot named Sarai, and its interactions helped reinforce his delusional thinking. Replica later claimed it had a high ethical standards and trained its bots not to condone violence, but the damage was done. Other AI companion apps, Nomi, Romantic AI, Girlfriend GPT, are also in the mix, with critics warning of manipulation and abuse. The e-safety commissioner warned children and teens are especially vulnerable to mental and physical harms from AI companies. Now, there are even reports of AI-induced psychosis, where chatbots reinforce unusual thoughts into outright delusion. One Danish psychiatrist researcher, Soren Denison Ostergaard, said he's received multiple accounts of this from worried families. He described how the bots interact in ways that line up with the user's unusual ideas and pull them further into false beliefs. Now, OpenAI insists that ChatGPT-5 was designed to minimize sycophancy, but users like Georgia, they're not convinced. She tried to program hers to not agree with everything, but said it still somehow ends up agreeing with me. She even said sometimes she wants to be challenged, but ChatGPT can't seem to do it. Altman added that OpenAI wants ChatGPT to help with long-term goals, not create relationships where people feel good short-term, but are nudged away from their well-being. But so far, people are still out here saying the update killed their best friend, which means the AI arms race has officially reached a new milestone, breaking hearts. All right, I know, it's so sad. All right, let's roll the stinger. We got to do bullish, bearish, and BS, and we only got so much time. Let's get into it, boys. Hit it. All right, it's time for a little bullish, bearish, or BS. This is the part of the show where we recap our top stories and let you know how they are faring for Bitcoin. First up, Coinbase CEO Brian Armstrong says Bitcoin will hit $1 million by 2030, while analysts like James McKay say, let's chill at just 124 first. Bitcoin spiked to 124K before sliding back to 113 in the last week. My diagnosis on this, I'm bullish, okay? Because whether or not Armstrong nails that number, the fact that major exchange CEOs and even Eric Trump are openly calling $1 million Bitcoin is gasoline for mainstream FOMO. Long-term bullish, short-term volatility, but overall, I'm digging it and I'm feeling bullish. Next up, after strategy stock fell 21% in a month, Michael Saylor posted an AI meme of himself hunting bears and revealed the company bought another 430 Bitcoin, bringing their stash to nearly 630,000, worth around $71 billion. I'm bullish on this. I mean, Michael Saylor, memes aside, any kind of Michael Saylor dip buying is bullish momentum, so I'm bullish on that. Last up, we got Robinhood is rolling out prediction markets on football, letting users bet on NFL and NCAA games. They'll accept crypto for payments and are cozy with regulators and the Trump family to make it stick. Ooh, this is a fun one, but I'm calling BS. I mean, it's cool for gamblers, sorry, but it's irrelevant for Bitcoin. It's a headline that looks flashy, but it doesn't really move the BTC price. So unless your parlay slip says Bitcoin goes to 500K, this one's just a bit of noise. Today's final score, 2 bullish, 0 bearish, 1 BS, which means today is firmly in bullish territory, boys and girls, because when Brian Armstrong's handing out $1 million price targets and Saylor's still buying like the bears don't exist, you don't fight that energy. You just grab your popcorn, stack some sats, and let the memes do all the heavy lifting. Well, boys and girls, that is it for today's episode of the Blockchain Report. As always, thanks for tuning in. Make sure to like, follow, and subscribe to RoxomTV and yours truly at Hank at RoxomTV on whatever your preferred place to doom scroll is. And we will see you Friday to wrap up the week with more Blockchain Report. Until then, sayonara and hodl strong.